On a Friday in March 2021, one man was quietly worth more than $30 billion. By the following Monday, it was gone. Not over months, not over weeks, in a single weekend. He wasn't a household name. No magazine covers, no congressional testimony, no public company. He operated in almost total secrecy, and that secrecy is exactly what let him build one of the largest hidden fortunes on Wall Street, right before it triggered one of the fastest collapses in financial history. This is the story of Bill Hwang and the family office that quietly threatened to take down half of Wall Street with it. Bill Hwang wasn't new to Wall Street, and he wasn't new to controversy either. He trained under legendary investor Julian Robertson at Tiger Management, one of the most respected hedge funds in history. Hwang later launched his own fund, Tiger Asia, and became known for aggressive, concentrated bets. But in 2012, Tiger Asia pled guilty to criminal fraud charges over insider trading in Chinese bank stocks. Hwang was banned from managing outside investors' money and fined tens of millions of dollars. For most people, that would be the end of the story. For Hwang, it was a loophole. He converted his operation into a family office, Archegos Capital Management, technically managing only his own money, because family offices weren't required to register with the SEC the way hedge funds are. Archegos operated almost entirely outside public view. No disclosures, no public filings showing what he owned. Nobody outside his small circle of banks knew how big or how risky his bets had become. Within a few years, Hwang had rebuilt a fortune worth over $30 billion. On paper, he was one of the richest people most of Wall Street had never heard of. Here's what made Archegos different from a normal, even a normal risky investment fund. Nearly all of it was borrowed. Hwang didn't buy stocks directly. Instead, he used financial instruments called total return swaps, arranged through major banks like Credit Suisse, Nomura, Morgan Stanley, and Goldman Sachs. A swap let Archegos get the financial exposure of owning a stock, all the gains and losses, without ever actually owning the shares, and crucially, without that position ever appearing on public disclosure filings. Because each bank only saw its own piece of Archegos' trades, no single bank realized how enormous or how concentrated his total position really was across all of them combined. He was effectively borrowing the same conviction bet, Viacom CBS stock among them, from 5 or 6 banks simultaneously, and none of them could see the full picture. By early 2021, estimates suggest Archegos controlled well over $50 billion in stock exposure, built on a base of roughly $10 to $20 billion of Hwang's own capital. That's leverage of 5 to 1 or more, stacked entirely on trades invisible to regulators and to the public markets. It was a fortune built on borrowed conviction, spread across banks that had no idea how exposed they collectively were, until one stock started to fall. The trigger was almost mundane. In late March 2021, Viacom CBS announced a stock offering to raise capital, which pushed its share price down. For a normal investor, a stock dip is a bad day. For Archegos, with its enormous borrowed position concentrated in just a handful of stocks, it was catastrophic. As the value of the position fell, the banks issued margin calls, demanding Hwang put up more cash to cover the shortfall. Archegos couldn't meet them. And because Hwang's exposure was spread across multiple banks who didn't know about each other, there was no coordinated plan, no orderly unwind. On the weekend of March 26, 2021, the banks realized what was happening, and each one quietly began trying to sell Archegos' stock positions before the others could, to limit their own losses. It became a race to the exit. Whoever sold first lost least. Whoever hesitated got crushed. On Monday, March 29th, 2021, the dumping began. Tens of billions of dollars in stock hitting the market within hours, sending share prices in Hwang's core positions crashing. Goldman Sachs and Morgan Stanley moved fastest, unloading their exposure early and limiting their damage. Nomura and Credit Suisse were slower and paid for it. Credit Suisse alone lost approximately $5.5 billion. Nomura reported losses of roughly $2 billion. Combined losses across the banks involved topped $10 billion. Bill Hwang's personal fortune, an estimated $30+ billion just days earlier, was effectively wiped out in the span of a single weekend, one of the fastest destructions of individual wealth in financial history. For Credit Suisse specifically, the losses were so severe they became one of the contributing wounds that would ultimately help push the 200-year-old bank toward its eventual collapse and emergency takeover just 2 years later. Regulators and prosecutors moved in quickly. In April 2022, Bill Hwang was arrested and indicted on federal charges including racketeering, securities fraud, and market manipulation. Prosecutors alleged Hwang had deliberately misled banks about the size and concentration of his positions to obtain more financing than he ever should have been given, and that he manipulated stock prices to inflate the value of his holdings. The trial stretched into 2024. In July of that year, Bill Hwang was found guilty on multiple counts of fraud and market manipulation. In 2025, he was sentenced to serve time in federal prison, closing the book on a collapse that had wiped out tens of billions of dollars in a single weekend and rattled some of the largest banks in the world. The Archegos collapse wasn't really about one bad stock bet. It was about how much risk can hide in plain sight when nobody has the full picture. Regulators couldn't see it because family offices weren't required to disclose. Banks couldn't see it because each one only saw their own slice of the trade. Even Hwang's own history of fraud didn't stop him from being handed enormous amounts of leverage all over again. The real lesson isn't avoid leveraged trading. It's this: when risk is deliberately structured so that no single party can see the whole picture, that opacity isn't an accident. It's often the entire point. Wall Street learned that lesson the hard way, in one weekend. If you want to understand how the biggest financial collapses in history actually worked, the mechanics behind the headlines, this channel breaks one down every week. Subscribe, and I'll see you in the next one.